Have you ever wondered how big investors, business leaders, or traders manage to stay afloat even when everything seems to be sinking? The secret lies in one word: risk management. Risk Management Story is the book that teaches you how to identify and control risk in every decision, turning it in your favor. It's not just about avoiding losses, it's about having a mindset of making deliberate choices at every step. Welcome to Trading and Finance. Hello friends, welcome to Trading and Finance, where every week we bring you summaries of books that give a new direction to your thinking, strategy and success. Today, we'll explore the master formula of risk management that can help you win the real game in any field, be it finance, trading, or business. So, watch this video till the end, because it's crucial to think correctly before taking risks. Chapter 1, Part 1. Embracing Risk. When you're afraid to take risks, you don't just miss opportunities, you also lose out on your potential. That's why successful investors and traders aren't afraid of risk. They measure it, understand it, and control it. The second part of this chapter delves into that depth, where risk isn't just a fear, but a science. Every trade involves risk, and it's essential to know how to identify that risk. Have you ever considered how one wrong decision can wipe out your entire capital? But if you've prepared for it beforehand, that same risk can turn into an opportunity for you. Risk assessment is an art that every professional trader masters. This primarily involves evaluating your capital. How much capital do you have? How much of it are you willing to allocate to a single trade? And how prepared are you mentally to lose that portion? Following this is the trading plan. Have you already determined your entry and exit points? Do you have a backup plan if the market moves against your expectations? These questions might seem trivial, but the answers to them determine whether you're a professional or just relying on luck. The concept of risk-reward ratio also explains this. It's about how much risk you're taking in a trade and what return you can expect for that risk. A smart trader always aims for a reward that's significantly higher than the risk, so that even if a few trades go wrong, the others can cover them. Now let's talk about position sizing. This refers to the amount you invest in each trade. It entirely depends on your account size, risk tolerance, and trade opportunity. A pro trader never puts all their funds in one place. They always control risk by dividing capital into different parts. Emotions also play a huge role in trading. Fear, greed, excitement, all of these can influence your decisions. But when you understand risk as a science, you can rise above these emotions. Your mindset also develops accordingly. You begin to believe that losses are part of the process, not a sign of failure. You learn that risk doesn't mean loss, but an opportunity that, if managed correctly, leads to great success. In this part, you've learned that risk isn't just a name for fear. It's a mathematical, mental, and strategic process that, if adopted wisely, can take you where 90% of people never reach. Chapter 1, Part 2. The Necessity of Risk Management. Becoming a good trader isn't just about correct entries and exits. It also depends on how wisely you control your risk. When people step into the stock or crypto market, all their attention is on making profits. But they forget that if losses aren't managed correctly, profits remain just a dream. That's why risk management isn't an option, but a necessity. Now imagine if you have 10,000 rupees and you risk 5,000 rupees in a single trade. You've already pushed yourself into a corner. This is an emotional decision, not a practical one, and the market runs on logic, not emotions. A professional trader first considers in every trade how much they could lose if the trade goes wrong, and whether they can bear that loss or not. This mindset keeps them afloat in the long run. Now we come to a very important point: position sizing. Position sizing means how much capital to allocate to each trade. If you ignore position sizing, you're putting your entire capital at stake in a single trade. Let's say you have 1 lakh rupees and you decide to risk a maximum of 2% of your capital in each trade. So your risk in one trade is 2,000 rupees. Now if a trade goes into a loss, you're only down by 2%. Whereas, those who trade without sizing incur losses of 20 to 30% in a single loss. Those who don't set stop losses to prevent losses are just trading on luck. A good trader knows that cutting losses quickly and letting profits run is the real win. If you set a stop loss for every trade, you mentally set a limit that you won't tolerate more loss than that. It's like a mental protective shield that saves you from emotions. A big mistake many traders make is getting stuck in a bad trade and hoping to fix it by throwing more money into it. This is called averaging down. When your trade is going down and you put more money into it, you're doubling your risk. Remember, there's no place for ego in trading. Accepting a wrong trade and exiting in time is the mark of a smart trader. Now let's talk about mindset. Understanding and accepting risk requires a strong mindset. When you accept that losses are part of trading and that there's something to learn from every loss, then you become a better and stronger trader. Not running away from risk, but understanding and embracing it is what makes you a master. So far, you've learned that risk management isn't just a technical tool, but a mental exercise. It needs to become a daily habit. When you start deciding how much risk to take, where to place stop losses, and with what amount to trade before every trade, that's when you truly start thinking like a professional. Chapter 2, Part 1. Measuring risk. Now you might be wondering, how do you measure risk? Is there a scientific method for it, or is it just a guessing game? The truth is, correctly measuring risk is the greatest strength of every successful investor and business leader. When you learn to identify, measure, and understand risk, only then are you capable of making real decisions. This is the art that transforms you from an ordinary investor into a pro. To measure risk, you first need to understand that risk isn't just the fear of losing money, it's also an opportunity. Risk means uncertainty, meaning you don't know what's going to happen next. This uncertainty influences your decisions. Now let's talk about some parameters that help in understanding risk. The first is variance scale, which is how much fluctuation there is in your investment returns. The higher it is, the greater the risk is considered to be. The second is standard deviation. This tells you how much your actual returns can deviate from your average returns. In simple terms, the higher the standard deviation, the greater the danger. Besides this, another important concept is Bayesian thinking. This means constantly updating your risk assessment based on new data. For example, if you've invested in a company and its reports start coming in poorly after some time, if you have Bayesian thinking, you'll change your previous estimate and make a new decision based on the new data. This is smart investing. One more thing that is often overlooked is the impact of emotions. Whenever you make decisions out of fear, greed, or overconfidence, you misjudge the risk. That's why, to accurately measure risk, you need to free your mind from emotions. Only a calm and neutral mind can understand the truth of risk. In the real world, whenever a big investor puts money into a startup, they don't just look at the idea or the founder's passion. They look at how much risk is involved and whether there's a way to reduce that risk. They ask themselves, am I willing to bear this risk? Do I have a backup plan? We need to adopt this same mindset. Another way to measure risk is through what-if analysis. That is, what if something goes wrong? What if the market crashes? What if the product flops? What if the team leaves? What will you do then? Thinking this way not only helps you estimate the risk, but also prepare an action plan. Now you understand that measuring risk isn't a mystery, but a process. It's a skill you can apply in everyday life too. When you choose a new job, when you start a new course, when you partner with someone, there's risk everywhere. But now the difference will be that you'll be able to identify it beforehand and make better decisions. Chapter 2, Part 2, Controlling Risk. When we talk about risk management, it's crucial to first understand that risk is not always beyond our control. In fact, most of the time we can control it with the right mindset and strategy. The biggest mistake any trader makes is viewing risk as a fear. Whereas in reality, risk is a tool that can teach you to make better decisions. Now understand this. Risk doesn't mean loss. Risk means probabilities. And the person who knows how to manage these probabilities well becomes the real master. Suppose you've planned a trade and taken a 10% risk in it. But if you've taken that risk based on logic, such as trend analysis, technical breakout, or based on fundamental news, then you're working through a process. And this process can bring you success repeatedly. The first step to managing risk is to identify it. That is, you should know where you are taking risks. Sometimes people put money into trades, but they don't know what their maximum risk exposure is. This is a very dangerous situation because this is where greed, fear, and panic begin. And these three emotions are a trader's biggest enemies. Therefore, first, calculate the risk factor of every one of your transactions. How much money is at stake? At what level to place a stop loss? At what target to book profit? All this should be decided beforehand. And only when this is decided should you enter that trade. Remember, unplanned trades always put your capital at risk. Now, another very important point is diversification. This means distributing your investments across different places. If you put all your money in a single asset and it goes down, your entire portfolio will sink. But if you've spread your risk across several places, even if there's a loss in one sector, the other sectors can balance it out. This is why smart investors always invest in different asset classes, such as stocks, bonds, mutual funds, real estate, and gold. So, the essence of this section is, don't view risk as fear. Understand it as a discipline. Risk management means clarity in your decisions, control over emotions, and moving forward with logic. These three things differentiate a successful trader from an average one. Chapter 3, Part 1. The Discipline of a Trader. Successful trading is never just about a good entry or an excellent exit. The real game is about the mindset hidden behind every decision, and the cornerstone of this mindset is discipline. Without discipline, no matter how much information or how many tools you have, you cannot become a stable and long-term trader. Imagine you decided to follow a trading system, but when the market goes against your expectations, you abandon your plan out of fear. Or, out of greed, when your target has been met, you keep holding the trade hoping for a little more. The result is a loss, and this loss makes you realize that along with information and strategy, the most important thing is your mental state. Discipline doesn't just mean following rules. It means trusting your system every time, no matter what emotions are telling you. It means making a habit of setting a stop loss every time. It means not taking any step outside the plan. All these things sound easy to hear, but the real test comes when there's a sudden sharp decline in the market, or when unexpected news shakes up a trade. It's at such times that the difference between a disciplined trader and an emotional trader becomes apparent. Suppose you decided to risk only 2% of your account in any trade. Now, the market has given you a setup that looks extremely attractive. You think, this time, let's take a 5% risk because this opportunity is special. This is where discipline breaks, and in the long run, such small breaks cause big losses. The most dangerous line in trading is, just this once. The other side of discipline is consistency. You follow the system one day, then mess up the next due to emotions. This doesn't yield long-term results. But if you consistently follow your process, even if you don't win every time, your system gradually starts working. So if you really want to make money from trading, and do so consistently, you have to train yourself. You have to calm your emotions and trade with discipline every time. This mental strength will make you stand out from thousands of other traders. Chapter 3, Part 2. The Power of Repetition. Now let's talk about the most difficult part, where most traders give up. Repetition. Looking at the same chart every day, understanding the same patterns, following the same risk-reward can sometimes feel very boring. But a successful trader is one who endures this boredom and continuously follows their process. They trade with discipline every time, whether their mood is good or bad. Here's something very important to note. Every successful professional, whether an athlete or an army soldier, turns their actions into habits. Similarly, for a successful trader, making the right decisions becomes a habit. When the market is moving up and down rapidly, they automatically follow their process instead of reacting in a panic. If you constantly think about how many trades you should take today, where to place a stop loss, or when to exit, it means your system isn't solid yet. But when all these decisions are fixed within you, that's when you enter the zone where trading becomes a natural process. Then, neither fear stops you nor greed distracts you. One more thing. Sometimes you get tired while trading, but you still don't stop trading. The reason for this is the addiction to overtrading. When you feel it's necessary to react to every move, that's when you break discipline. A successful trader knows when to do nothing. Sometimes, no trade is the best trade, and this understanding builds your mental maturity over time. So if you want to progress on this journey, don't just think about what setup you need. Think about how much you are strengthening yourself every day. Can you control your emotions? Do you stick to your rules every time? Because remember, true success lies not in the system, but in the power to consistently follow that system. Chapter 4, Part 1. The Mental Framework of Risk Management. Have you ever wondered why two different people follow the same system, yet one consistently profits and the other repeatedly incurs losses? This difference is due to their mental framework. Risk management isn't just a technical thing, it's a mental discipline. How much risk you're willing to take and how often you can stop yourself, that's the real test. When we talk about risk, the first thing that comes to mind is exposure. Many traders think that the more money they invest, the more they will earn. But this thinking leads in the wrong direction. A smart trader knows that the right amount of exposure is necessary, not just more. They risk only a certain percentage on each trade, usually 1% or 2%. By doing this, not even a single bad trade can wipe out their entire account. The second point is dealing with drawdowns. Every trader has to face drawdowns at some point, meaning continuous losses over several trades. But the difference is that a smart trader doesn't panic. Instead, they reduce their trade size during that time and remain emotionally calm. They know that this is just a phase, and if they've chosen the right system, profits will return. The third and most crucial point is position sizing. Most people ignore it, but this is the biggest weapon. When you determine your position size according to the risk, whether your stop loss is small or large, your loss remains the same every time. This helps you stay in the game for a longer time, and your mind remains calm. And one thing people forget, risk isn't just about losing money. It's also about missing opportunities. When you start taking trades everywhere, you forget to focus on the real setups. Therefore, it's essential to put your energy and focus only on high-quality setups, rather than reacting to every small move. So the next time you open a chart, don't think about where to make money. Instead, think about where your risk is lowest and your reward is strongest. Because understanding and controlling risk is what truly makes trading a profession. Chapter 4, Part 2. Risk to Reward Ratio and Review. Whenever a new trader enters the market, their focus is only on returns. But professionals always focus on one thing, the risk to reward ratio. Before every trade they ask, is this risk worth taking? And this question sets them apart from the crowd. Now, imagine you're getting a 1:3 ratio in a trade. This means you can risk 100 rupees to earn 300 rupees. If your strategy is even 50% accurate, you'll still be profitable in the long run. This math isn't magic, it's logic, and this logic prevents you from playing trading like a game. The next thing is review and analysis. Many people take trades, but later forget what was right and what was wrong. A professional risk manager records every trade, entry, exit, result, and emotions. This process prevents you from repeating the same mistakes over and over again, and this learning transforms you from normal to expert. You also need to understand that every risk comes with a price tag, and you have to choose which risk to accept and which to let go. This means that when you enter a trade, it should be clear under what circumstances you will exit it, i.e., a pre-planned stop loss. And yes, the most dangerous aspect of the market is overconfidence. When some trades go right continuously, people increase their risk, and that's where the biggest losses occur. That's why true professionals always trade with the same discipline, whether it's a loss or a profit. The essence of this chapter is, your real profit is hidden in the decision where you manage risk, not in dreaming of profits. The better you learn to control your losses, the more profit will come to you naturally. Chapter 5, Part 1. The Science of Position Sizing. If you want to truly master trading, simply looking at charts, indicators, or news analysis isn't enough. You need to understand the science of position sizing gear, which means how much money to put into each trade. This is where the difference between an amateur and a professional trader becomes apparent. Imagine two traders. Both have the same strategy. The first one put 50% of their entire portfolio into one trade, and the second put only 5%. Now, if the trade goes wrong, the first trader's entire capital is shaken, while the second trader just took a small loss and moved on. This is the power of risk diversification. Position sizing isn't just a technique to save money, it also gives you peace of mind. When you know that your entire portfolio isn't going to sink in any situation, you can make decisions with a clear mind. Another important point is understanding the equity curve and drawdown. Your trading growth isn't a straight line, it has ups and downs. But how to handle those ups and downs depends on your position size. A small size means fewer fluctuations, a large size means more volatility. So think, if you want your money to last and grow for a long time, it's crucial to know how much risk to take in each trade. This is the game changer. Chapter 5, Part 2. The Art of Adjusting and Reviewing Position Sizing. The true meaning of position sizing isn't about investing the same amount every time. It means adjusting the amount based on your trade's risk and your account size. As a trader, you need to decide what percentage of your capital you're willing to commit to each trade. Professional traders typically adopt a 1% to 2% risk rule. This means if you have 1 lakh rupees in capital, you're willing to risk 1000 rupees to 2000 rupees per trade, not exceeding 2000 rupees. What does this achieve? Even if 4 or 5 trades go wrong consecutively, you're still not out of the game. Now let's talk about the trading journal JIL, a tool that most people ignore but can be your greatest strength. Record every trade's entry, exit, logic, size, and result. This will not only help you understand your own patterns, but also identify which strategies are more profitable and which aren't. Another aspect of position sizing is the risk-reward ratio. Before every entry, ask yourself, is the reward for the risk I'm taking justified? If you're risking 100 rupees, is there an opportunity to earn at least 200 rupees? That is, a 1:2 ratio. If not, it might be better to skip that trade. The point is simple. If you take trading seriously, you must take position sizing just as seriously. This is the key that allows you to protect yourself from market uncertainties and consistently move forward. Chapter 6, Part 1. The discipline of a trading plan. Have you ever wondered what the most powerful skill of the world's best traders is? It's discipline. To make money in the market, knowledge is important, experience is important, but above all is self-control. And this is where the trading plan comes in. Every successful trader has a precise and clear trading plan. A plan that provides clear direction without any emotional decisions. It defines when to enter, when to exit, how much risk to take, and under what conditions to do absolutely nothing. The trading plan operates without listening to the mind, because the mind thinks something different every second. Fear, greed, doubt, hope, all these emotions cause problems in the market. But when you have a plan, you can silence these emotions. You should know that if this setup appears, only then will I trade. If it doesn't appear, the computer will remain on all day, but I won't trade. This is true discipline. The other aspect of discipline is accepting losses. Many people consider every loss their fault, feel ashamed, and then double their risk in an attempt to recover that loss the next time. But a professional trader knows that loss is part of trading. It's not a shame, but a statistic that strengthens your returns in the long run. That's why you should document your losses, understand their cause, but don't chase after them. In trading, every decision should be rule-based, not emotion-based. Chapter 6, Part 2. The Power of Routine. Now let's talk about the strength that keeps you afloat in the world of trading. Routine. A stable, repeatable, and disciplined routine is the tool that helps you maintain a steady state of mind, no matter how much the market is fluctuating. Every successful trader's day begins with the same start: morning preparation, market analysis, news updates, identification of levels, and sitting at the trading table with a clear vision. These small habits create that zone within you, which is called the flow state. In a flow state, a person neither overthinks, nor fears, nor becomes impatient. They simply act with complete attention, focus, and confidence. This is the state from which the best trades emerge. And the path to entering that zone is practice, preparation, and patience. You need to prepare yourself daily, physically, mentally, and emotionally. You have to believe that trading is not gambling, not a fluke. It's a profession, as serious as that of a doctor, engineer, or scientist. Along with this, you also need to know how to learn from your mistakes. Write them down daily in a trading journal. What was the trigger? What went right? What went wrong? What was your mindset at that time? And what could be better next time? When you do this, every defeat becomes a stepping stone to victory. And that's where the transformation begins, that turns an ordinary trader into a master. Chapter 7, Part 1. Rule-based systems and self-control. Have you ever wondered why some traders consistently profit every month, while others repeatedly get caught in the same cycle, sometimes greed, sometimes fear, sometimes overtrading? The answer is rule-based systems and self-control. Trading isn't just a game of looking at charts and candles. The real game is sticking to your rules even when the market is tempting you, misleading you, and you feel like it's time to take a risk. But no, the right trader stops there with their rules. These rules could be: what will be the risk percentage? What's the entry signal? Where will the stop loss, SL and take profit, TPB? How many times can you trade? And what not to trade? The stricter the rules, the deeper the freedom. Because when the mind is covered by rules, emotions don't lead you astray. In this chapter, we will understand how you can create a trading system for yourself that runs purely on logic, not emotions. This system brings your habits, strategies, and your life into a routine, making trading sustainable. And the biggest role in this is played by discipline. Do you follow the same plan every time? Do you never enter without confirmation? Do you exit the trade as soon as the SL is hit, or do you hope for a comeback? Those who don't have rules for themselves become slaves to the market's rules, and those who operate by their own rules can bend the market to their will. Chapter 7, Part 2. Building your perfect trading system. A perfect system isn't magic. It's a structure built from your experience, mistakes, and improvements. First, you need to understand your trading style. Are you a swing trader, day trader, or positional trader? What's your time frame? 15 minutes, 1 hour, or daily chart? These questions aren't just technical, they're also connected to your lifestyle and mental strength. Now let's talk about that structure. A good system stands on 4 main pillars: entry rules, exit rules, money management, and psychological fitness. Entry rules mean when and why you will take a trade. This includes technical setups, indicators, support, resistance, volume, etc. Exit rules mean when to get out. How far will the SL be? How much profit to take? Will there be a trailing stop loss? Money management determines how much capital each trade will allocate, 1% or 2% risk. And finally, psychological fitness assesses whether you are making trade entry and exit decisions based on emotion or on the system. Practicing all of this is the game changer. Just creating rules isn't enough. You need to write them down, test them on charts, and then review them after every trade. Maintain a journal. Note every entry, exit, emotion, mistake, and lesson learned. Sit down every week and audit your system. Did it yield a profit? Did you follow the system? If not, why not? This self-assessment will make you as precise and strong as a machine. And remember, the best system is the one that works for you. Before copying someone else's system, know yourself. A system that you understand, embrace, and trust is the best trading system for you. Chapter 8, Part 1. The Mental Battle of Trading. Have you ever asked yourself why you repeat the same mistakes even when you know they are mistakes? This is the real battle of trading, the battle of the mind. You see the right entry on the chart, the system is also saying it's the right time. Yet, you hesitate, fear, or rush. Why? Because trading is not just a technical game, but a test of mental discipline. When money is at stake, our emotions, fear, greed, hope, and regret take control. And this is where the importance of trading psychology begins. A successful trader's mind is calm, focused, and stable in any situation. But does this happen overnight? Absolutely not. It requires working on oneself. The first thing is self-awareness, meaning understanding yourself. When you trade, what is the pattern of your emotions? When do you feel fear? When do you become overconfident? When do you make wrong decisions? Recognizing these tricks of your mind is the first step towards changing it. The second is emotional discipline. This doesn't mean you have to become emotionless, but rather you need to learn to follow the system despite your emotions. This is not just a game of knowledge, it's a game of practice. Every time you break discipline, identify that moment and ask yourself, is this what my system is telling me, or is it my fear speaking? The third is mental rehearsal. Just as athletes visualize before a match, you too need to see your trading day in your mind beforehand. Imagine yourself as a calm, focused, and process-oriented trader. This practice helps to stabilize your mind and stick to the strategy. Chapter 8, Part 2. Your roadmap to a professional mindset. The true root of your trading mindset lies in identifying and controlling your emotions. So let's now talk about the roadmap that can bring your mind into the professional zone. The first and most important thing is routine. Yes, a precise, repeatable, and strategic daily routine. Every successful trader has a morning ritual, a protocol that mentally prepares them. This could be meditation at the start of the day, a quiet analysis time, or simply asking yourself, how dedicated am I to my system today? Such a routine enhances your focus and calms emotions. The second habit is the trading journal. When you record every trade, every emotion, every mistake, and every win, you become your own greatest teacher. This journal doesn't just show statistics, it shows you a mirror to yourself. It helps you understand emotional patterns, tendencies to go against logic, and your improvement over time. The third thing is detachment. In trading, treat every transaction like a game, neither too much hope nor too much fear. It's important to know that one trade doesn't determine your success or failure. The real victory is following the system, even if there are a couple of losses. When you reduce attachment to outcomes, you start making more professional and calm decisions. The fourth practice is taking breaks. Continuously staring at screens or trading without a break leads to fatigue and emotional imbalance. Professional traders know when to stop, when to think, and when to come back. You too should develop the habit of taking some time off every week to reset yourself. And finally, the most important, long-term thinking. Today's profit or loss is nothing if you can't see the bigger picture. Trading is a marathon, not a sprint. Every day, strengthen the mindset that is based on long-term success. When you adopt these 5 practices, daily routine, journaling, detachment, breaks, and a long-term mindset, your mind gradually enters a zone where there is less noise, more clarity, and precise decisions. Chapter 9 Part 1 Turning Losses into Lessons. Have you ever wondered how to make defeat your greatest teacher in trading? Most people see defeat as the end, but true mastery lies in living with defeat and learning from it. First, understand that every trader has to incur losses. This is not a failure, but a rule of trading. When you don't take losses personally, but rather see them as an opportunity to review your system, your mental strength increases. The most effective way to manage losses is risk management. This is not just about saving money, but also a strategy to keep your emotions in control. When you know how much risk to take in a trade, you rise above fear and greed. For this, you need to commit only a certain percentage of your capital to each trade. What will this achieve? Your losses will be limited, and your mind will remain calm. When your mind is calm, you'll be able to make better decisions. Furthermore, another important point is the correct use of a stop loss. This is a rule to close your trade in time, which prevents losses. But remember, setting a stop loss correctly is also an art that comes with practice. Learn to manage your emotions after a loss as well. Rushing into decisions due to disappointment, anger, or panic is the biggest mistake. In trading, maintaining a stable mental state before every mistake is the first step towards victory. When you accept losses and start learning from them, you become a true master trader. Chapter 9, Part 2, Mastering Your Mind in Trading. When it comes to trading, your biggest weapon is your mind, or rather, your mental state. The secret behind successful traders is that they keep their emotions in check. Fear, greed, panic, all these emotions can lead your decisions astray. First, you need to understand your mental state. When you trade, your mind continuously sends 2 types of signals, one of your fear and the other of greed. Both of these compel you to make wrong decisions. Breaking this cycle is extremely important. How to do it? The simplest way is to give yourself a discipline towards trading. Create rules and follow them strictly, such as setting a risk limit for every trade, placing a stop loss, and not trading without a plan. These rules protect you from emotional decisions. Additionally, start noting your emotions. Whenever you trade, write down your mental state and feelings. This practice will help you understand in which situations you get disturbed and when you can make better decisions. Meditation or mindfulness exercises are also very helpful. These techniques keep the mind calm and help you focus on the present.